Good afternoon, Trinidad and Tobago, and welcome to Inside Insurance. You know what we do. It's brought to you with the kind compliments of the Guardian Group, and we talk to Guardian Group experts from time to time on different issues in insurance. And today we'll be talking retirement planning. And with me in studio is Mr. Fize Mohammed, Unit Manager of the Ramlal Basdios branch of Guardian Life of the Caribbean, and we'll be talking with Fize in just a little bit. I'll just remind you, this program, live before Inside Insurance, is brought to you with the kind compliments of Guardian Group.
Who do you love? Who do you think about, plan for, want to protect? They are the reason to choose Guardian Life's pension solutions. If you love them and want to plan your future, call us today and let us help you show your love. Guardian Life of the Caribbean. Live long. Live easy.
And good, welcome back. As I said, we are here on 95.5 FM. This program is called Inside Insurance, brought to you with the kind compliments of Guardian Group. And as I said before, in studio with me is Guardian Group expert, Mr. Fize Mohammed. He's a unit manager and with Guardian Life of the Caribbean. And today we will be talking retirement planning. And of course, we'll open the lines a little bit later on, but we kick things off. And we're going to ask Fize, welcome. Nice to have you here.
It's a pleasure to be here.
Good. So let's jump right into it.
Of course.
When should I start retirement planning? When is the best time?
Well, John, there's a saying, start early, drive slowly, reach safely. It doesn't only apply to driving,
right,
but in everything in life. And more so with our retirement planning. And the reason why you want to start as early as possible, for example, as soon as someone starts working, which is normally in their early 20s or earlier, you want to start planning early because two things work for you, interest and time.
Mm-hmm.
So the phenomenon of compound interest gives your money enough time to grow so that when it is you really want to use it at retirement, you have a fund of dollars that will be able to satisfy your need. So the earlier one can start putting money into retirement planning, it's better. And it's also good to put money when you're able to earn it in your younger years. And in that way, the longer the time it takes, the smaller the amount. For example, if somebody starts at age 20, our minimum retirement age is 50. Mm-hmm. So they don't have to put a large amount simply because they have time on their hands.
Yeah.
So they can start with $200 a month, $300 a month, and give themselves 30 years or more to allow that money to grow over time together with interest.
Yeah.
So with compound interest, they can have a fund of dollars that will allow them to have a secure retirement income.
And that's the next question I was going to ask you. How much should one contribute to a plan in order to maintain one's current lifestyle?
Well, John, if I were to use you as an example, I don't know how much you earn, but you look very wealthy, even if the wealth is within. But let's say, for example, somebody has a current lifestyle, and in order to manage that current lifestyle now, it's about $15,000 a month. Now, normally when people are accustomed to that lifestyle throughout their life, when they retire, they want to maintain that lifestyle.
Correct.
Because many people at that age can't adjust, especially downwards, to a different lifestyle because they have been accustomed living a certain way. So there's something called the time value of money. So if my current lifestyle is costing me $15,000 a month, and I'm at age 25 now, I want to retire at age 55, that's 30 years. So with a timetable calculator, I can then see in 30 years I may need $30,000 to allow me at that time to have the current lifestyle that I have.
Right.
So then we work backwards and say, okay, at 55 I need $30,000 a month. How much money do I need to contribute now over that 30 years to give me the lifestyle of $30,000 a month? And that is how we can work it, and then you can start making those contributions now to maximize your benefit then.
All right, and how does national, let's say, tax incentives work, and how can I benefit from it?
Well, you know, John, over the years, regardless of which government is in power, the idea has been that we do not want to allow, especially retirees, people on the retirement line, to be a burden to the state,
Right.
because that could be a significant sum. So what government has done over the years is to provide an incentive to the working population to create and to provide their own facilities for retirement. And so currently, according to the current legislation, an individual can contribute to a registered annuity up to $50,000 a year, inclusive of national insurance. So somebody who contributes that $50,000 can now gain a 25% tax reduction. So for every dollar you put towards the annuity, you're going to save $25 in tax. So if I put $50,000, I'm saving 25% of $50,000, which is $12,500 per year, which is average about $1,000 a month. So $1,000 per month less in my tax. So therefore, I'll be taking home more money.
Understood. All right. Is there a limit to the refund that I can receive?
Well, naturally, the limit is based on the contribution you make, and legislation currently is that you can gain 25% tax refund on the maximum amount you could contribute, which is $50,000.
All right. All right. Is the tax incentive applicable to any type of retirement plan, including group employer group employer contributed plans?
No, it's not applicable to any retirement plan. It must be a registered plan. Registered means it's registered with the Board of Inland Revenue. And when you take a policy out with any insurance company, it has to go to Board of Inland Revenue to be approved. Once it's approved and registered with Board of Inland Revenue, then you can benefit from the tax.
All right. So, for example, if I have a retirement plan at work that my employer contributes to,
Yes.
can I benefit from that plan in
Absolutely.
terms of tax
You can.
incentives?
Once it's a registered plan, you
Right.
can benefit.
But do I benefit from my contribution or the employer's contribution, or both?
You can benefit from both.
All
Because normally, as an incentive, an employer might tell you, okay, John, to help you to plan your retirement, I could give you an incentive. Also, that incentive can create what you call job loyalty. So in addition to your group health plan, I could say, John, if you put $500 a month into annuity, I can match it
Okay.
up to a maximum of $1,000. So therefore, if you put $500 and your employer puts $500, you have the benefit of $1,000 going into your tax incentive safe plan, registered annuity, and you benefit from it.
All right, good. Will my retirement income be taxed though?
Well, you know, legislations change from time to time, but currently, yes, your retirement income can be taxed once it falls into a taxable income bracket. For example, John retires. His annuity payments per month is $10,000. That's $120,000 per
Right.
year.
Yeah.
He only is allowed, let's say he has a $60,000 personal allowance.
Right.
So therefore, the difference of
So
the other $60,000 becomes taxable.
Taxable.
So the first 60 is non-tax because he has the 60,000
Personal allowance.
personal allowance. Now, over the years or down the line, we don't know what tax incentive measures are there. But currently, if it falls above his allowances into a taxable bracket, he will have to
He'll have
pay
to
on
pay.
that portion that becomes
That
taxable.
becomes taxable.
Yeah.
All right, so a lot of good information here from Fize. We're going to be opening up the phone lines in just a bit to see if you have any other questions. Retirement planning, that's what we're discussing today on Inside Insurance. And of course, I'm reminding you that it's brought to you with the kind compliments of Guardian Group. All right, so we're going to take a short break and we will be back with your calls.
Who do you think about, plan for, want to protect. They are the reason to choose Guardian Life's pension solutions. If you love them and want to plan your future, call us today and let us help you show your love. Guardian Life of the Caribbean. Live long. Live easy.
All right, welcome back, and we're going to open up the phone line. 6223937 is the number if you have any questions on retirement planning. If you have any issues, I'm sure Fize is here. He will be able to answer those questions. And now, retirement is very, very important. We all know that. And planning for retirement. But one of the things you had said earlier, and we need, well, we could talk about it a little bit, is that the best time to start is from when you first, as early as you can.
Yes.
Once you're earning income.
Yes.
Right?
Yeah.
Now, at that point in time, let's say a young person in the 20s just started to work. The lifestyle that he might have then is going to be very different, let's say, probably in 10, 20 years.
Yes.
So, one of the things that you need to do is to, when you're having your discussions with your insurance representative or your financial planning person, is that you need to look down the road, right? Because that young person may not own a home as yet, may not own a vehicle, or he may own a car, but he will have no home, no family, etc., etc. So you have to be able to look down the road and see the kind of lifestyle you would like to have and cater for that in terms of your retirement planning.
Definitely.
Yeah.
Definitely.
You know, so now I know there are a number of different, how should I say, plans available. And we spoke about planning, but let's talk about some of the plans available in terms of retirement, what you can have. I know we're talking specifically now what Guardian Life of the Caribbean might offer, but let's talk about it. What plans are there that can be used for retirement?
Well, if I should speak about Guardian Life, and basically most insurance companies have similar type plans. Guardian Life has the registered annuity, and that registered annuity allows the individual, as I said, to make contributions either monthly, quarterly, semi-annually, annually, and over a period of time it generates interest. So interest and time, compound interest, allows it to develop what you call a fund value. And at the time of the person accessing the pension, which legally it's now from age 50 on to 70, there's a fund value that accumulates. The individual has two choices. If, let's say, the fund value is $1 million at the time of retirement, he gets 25% tax-free currently, according to legislation. The other 75% is then used to create an annuity where there is a guaranteed period first of the first 10 years, and then if he lives beyond the guaranteed period, he's paid that pension or annuity
for as long as he lives.
As long as he lives. So if he retires at 60 and we pay the guarantee period up to 70 and he lives to be 125, the Guardian Life will pay that monthly premium as long as he lives.
Fantastic. Now the other thing is, if for example I decided when I was 25, right, that I am going to start a registered annuity and I will pay X amount, and I say, well, retirement at 60, but then I get to 50, and when I inquire from my financial advisor, I see where my fund is, because I started early, and as you said, time, interest, compound interest worked in my favor.
Definitely.
And it's way beyond what I expected. Can I, although I had indicated that I wanted to retire at 60, can I move my retirement age up and take my retirement at 50?
Definitely.
Early retirement?
With discussion with your insurance provider, that is a facility that can be made available to you, because situations change, circumstances change.
That's right.
Yes.
So that is possible.
That
So you're
is
not.
possible.
If I initially indicated 60 and then things change in my favor, I can decide to bring it up earlier.
Yes.
Or push it back.
Yes.
Depending on how situations
Yes,
go.
as situations
Yeah.
go.
All right, that's good information.
Yes.
That's good to know. Anything else you'd like to share with the public retirement planning, specifically, Fize, while we wait and see if anybody will call with a question or two?
Okay, well, basically, John, there are three things that happen to individuals in life. One, we live too long. Two, we can die too soon. And three, we can become handicapped or sick.
Or disabled, yeah.
So when we talk about retirement planning, we're talking about living too long. Currently, the average lifespan of individuals globally now is about 79 years. So imagine somebody retires at 55 or 60. They have an average of, let's say, 20 years to live.
Mhm.
And if somebody is ill prepared or did not prepare for retirement planning and they have to live 20 more years, where is income going to come from? Where is money going to come from?
Correct.
Also, at that time, you're more prone to sickness, to disease. You may want to make a little travel in terms of making a little trip here and there. You may want to give your grandchild a gift. And so money becomes vitally important for your well-being, for your basic needs, for sickness, and even for a little travel. So that is why it is so vitally important. And when you see what happens now, John, people who did not plan or prepare accordingly, now they have to go back to work, not because they want to, but because they
have no
to.
choice.
They have no choice. So you see people at 60, 65 being security guards, going back in the construction industry, doing some part-time work, which is really not the way you want to be in the twilight years of your life.
Yeah.
So again, the importance of planning and starting early in life. And the earlier you start, you could make smaller contributions that is more comfortable to your pocket, because as you rightly said, you may have a mortgage, you may want to buy a car, you may have commitments with your children. So if you start early, you don't have to choke out a big chunk of money. But if you start late, naturally you have less time. So you have to invest more.
But let me ask you this. A young person starts a retirement plan, and because of the fact that he doesn't have too many financial commitments, he decides he'd put $1,000
Yes.
towards retirement, and he's able to do that for 10 years, 15 years, but then his situation changes. He maybe gets married, buys a home, so forth. Is it feasible that he can reduce his contribution to the annuity?
Yes, in fact, the contributions are flexible. He can
Okay.
either increase, decrease, or even put in lump sums.
Okay,
So
wonderful.
what a lot of people do, they may pay $500 a month for the first 11 months. A lot of people, they get a bonus in December, and they may say, okay, see this bonus? I could throw this $10,000 into my annuity, get a further tax break, and have more money to invest for my retirement.
Yeah. Right, so we cleared up a couple of things there, and I think that because there are some people that feel when you enter, when you take out an annuity, that you are tied to that first the initial premium. But it's good to know that it is in fact flexible. You
Yes.
can take it up, take it down, depending on your financial situation, and also you can put lump sums into the plan
Yes.
as well. So I mean, that flexibility allows you to better manage what will be there for you when you turn 50, 60, 65, or whatever the case might be.
Definitely.
Yeah. Wonderful. All right, so we're not getting any calls as yet. I don't know, like a lot of people are comfortable with their retirement, it would seem. And that's a good sign.
They probably have things in place, which is good
Yeah,
for the country.
which is good. Excellent for the country. Because, as I said that, we have a call. Hello, good afternoon. Welcome.
Hi, good afternoon.
Good afternoon. How are you?
Fine, thanks.
And where are you calling us from?
Good program. I'm calling from Quebec.
And nice to have you. Go ahead.
I just wanted to know, he's talking about young people, but sometimes young people don't think of annuity.
Correct.
What age would you suggest is the latest in which you can start one?
All right, fair enough. Thank you.
To be very honest, ma'am, as you know, the earlier you start, the better for you.
Yeah.
Now, there is no late age, but naturally, You don't want to start contribution when you're close to retirement.
Yeah,
because the purpose of it is to generate a fund so that you could benefit at retirement. And retirement age starts at 50.
Yeah.
So you want to at least give yourself a few years. Now, if circumstances are such that you start contributing at 40, you have to look at when do you want to retire. If
That's
you want
right.
to retire at 55, well, you still have a 15-year span, but you may have to contribute a larger amount. So the earlier you start, the better. But if you decide to start later, I mean, anytime later is good, but not too close to retirement, because you want to give yourself enough time for the money to grow and build interest.
And the other thing you have to realize, if you're going to start a little late, it's going to cost you a little more.
Definitely.
Yeah? Good afternoon. Welcome.
Yes, good afternoon.
Mhm.
I have a question.
Sure.
My question is, I am retired now, but I started an annuity at the age of 40. When I retired at 60, I cashed it in the 61st year. I was paying $300 a month. And do you know I had to pay $27,000 to the Board of Inland Revenue in taxes? Why? Why is
You have
this
to
like
pay
that?
20-something.
$27,000.
What is that?
$27,000. When I cashed in my annuity with Guardian, I had to pay $27,000 in taxes to the government. Why?
Okay. All right. Let's see if I has an answer for that. Sure.
Okay, I'll try and give you the best answer possible. But as we discussed just now with John, that you had two options at the time of annuitizing your pension. One is that if your fund value is 300,000, you have the option of taking 25% tax-free and then getting a monthly annuity, a monthly pension as long as you live. Or you could have not taken the 25% lump sum and just take a bigger monthly payment as your annuity. Now, this one I'm subject to correction or clarification. I think there's another option where if somebody wants to take everything one time, John.
That's right.
If you
And that is actually cashing in your annuity.
Cashing in the annuity.
Right.
Government will say,
Will
okay,
stay.
you want to take everything one time.
That's
We
right.
will take 25% of the fund value in tax and give you the
And
difference.
give you the difference.
But
yeah.
ideally, it's not.
That's not the purpose.
It's not the purpose, because when you do that, somebody could blow away that lump sum
Exactly,
in no time.
because the
and then-
idea, and probably she said at age 61.
Yes.
So that may have meant that she would have cashed in probably a little earlier than planned. No, and that's you're right, and that's probably the penalty, because if you're going to cash in, because an annuity really is to provide monthly income, isn't it?
Absolutely.
That's right.
Yeah.
So if you change that, you're going to have to pay taxes. Yeah. Good afternoon. Welcome.
Hello?
Yes, sir. Good afternoon.
Yes, sir. I have a question.
Please go ahead.
If I put $1 million with the company to get an immediate annuity, an immediate pension,
Mm-hmm.
at present, how much I could get a month?
Wow. I think what you'd have to do is I'd let Mr. Mohammed leave his number downstairs, and you could call back at 629292, and I'll give you that and you'll be given that number to call Fize privately, because that is something he'll have to sit and work out and get
Definitely.
information back from head office. All right?
Okay.
Fair enough.
Thanks.
So make sure call 629292, and Mr. Mohammed will leave his number and you can contact him. All right?
Thank you.
Thank you very much. 6223937. Some very interesting questions there, Fize.
And naturally, people
Yeah.
have their concerns.
Of course
these
they
are
do.
things that happen.
Yeah, these are things that do happen. And let's see who we have on the line. Good afternoon. Welcome.
Good afternoon.
Good afternoon, ma'am.
I started hearing the discourse when the question was asked if the employer contributes, if the employee can benefit tax-wise.
Mm-hmm.
I had to move away from the radio, so I did not hear the response. Can it be repeated, please?
Sure. You want to repeat it for
Yes, what
Fize?
we were saying, ma'am, is that once it's a registered plan that the employer is making the contributions towards, you can benefit from the tax. For example, if you have an employer that is contributing $500 on your behalf into a registered annuity, and that's $6,000 a year, you can benefit from the current rate of tax benefit now is 25%. So yes, once it's a registered annuity with contributions being made by employer, there's a benefit in tax for you.
Not only for you, but the contribution you make, but the contribution your employer makes as well. Yeah. Good afternoon, welcome.
Good afternoon, Mr. John. Good job. God bless you.
Good afternoon, so how are you doing?
I had to go off track a little bit. Having supported the PLM so strongly, all the PLM workers in Diego Martin haven't been paid the money.
Well, we not. This is not for that, and I'm gonna manage here, right? Because
off track
no, but you can't go off track because this is a program that we're doing that is specific to retirement, all right?
I'm trying to get on. I've been
Right. So unfortunately, I won't be able to entertain you. Yeah. 6223937. We're talking again retirement planning, and we have with us Guardian Group expert Mr. Fize Mohammed, and we're talking retirement. Hello, good afternoon, welcome.
Hi, John.
Yeah.
Hi, I'm just calling in to clarify something that Fize said just now.
Yeah.
And the lady asked about the contribution to the registered annuity.
Yeah.
And he indicated that an employer's contribution can be claimed on by an individual. That's what he said?
Yes.
Yes.
That's not correct,
It's not?
An employee can only claim on an employee's contribution, not the employer's contribution. Whatever the employer pays, the employer can claim on, not the employee. And in revenue does not allow that. Only the money that you have contributed up to a maximum of $50,000 a year, you can claim on.
But isn't let me ask you a question.
Sorry.
In terms of calculation of income, when, for example, for taxation purposes, isn't the employer's contribution to your annuity counted as part of your income?
No.
It's not?
The employer cannot contribute. The employer can contribute to an employer's plan on your behalf, but they cannot contribute to your plan. An employer cannot contribute to your personal annuity. And so I'm supposed to know that.
Well,
I think I have it different as well.
I think
Yes, I'm supposed to know that. An employer cannot contribute to an employee's personal plan. They can contribute to a plan where they're doing it on your behalf. So you can claim on your personal plan, and they will claim on their contribution on your plan.
All right,
At the time of retirement, you will get everything. All that you have contributed and all that
they have contributed. All right, for example, can an employer take out an annuity on my behalf?
Of course. But it's
Right.
a corporate annuity.
A corporate annuity. Good.
Yeah, but you can't claim on that contribution.
Okay. All right. We'll have that clarified, but thank you very much for the clarification.
And I will also, John, I will also look into
double
that
check.
because at the same time we don't want to give
Incorrect information, yeah.
But
All
we
right.
can have it clarified.
Yeah. Final call. Hello, good afternoon. Welcome.
Hi, good afternoon.
Yes,
I'm
ma'am.
just trying to clarify something here. The caller who just called in is actually incorrect.
He's actually?
Incorrect.
I kind of wanted to believe that as well because
The employer, if he is contributing to the employee's personal annuity, the annuity is in the employee's name, right?
Mm-hmm.
That is a benefit in kind. The employer's contribution is a benefit in kind to the employee. It is taxable in the hands of the employee. However, what the employee gets as a tax deduction is the entire amount.
Both his contribution and I thought that's how I knew it as well.
Tax on his employer's contribution, and he's allowed to claim these both on the both.
Right. Okay.
John,
Thank you very much.
But to mix that up with the corporate plan,
Which
where
is different.
the employer is the sole contributor.
Right. Thank you very much for
and
that.
once it does not exceed 20% of the total income or 33% of the chargeable income, whichever is greater, then it won't be a benefit in kind to the employee. And I'm speaking as an officer from the Board of Inland Revenue. I don't know
Thank you very much for that clarification.
Man.
Right. So, and that's the way I knew it as well.
That's the way I understand it. So it's good for the clarification.
Yeah, definitely. All right. So it's time to wrap things up. It's 4 o'clock in TNT, and it's time for our 4 p.m. News Center 5. And I want to say thank you very much, Fize, for coming and sharing in the discussion. We were discussing retirement planning, and with us, Guardian Group expert, Mr. Fize Mohammed. So, Fize, thank you very much.
Thank you so much, John. It was a pleasure.
And you can see, next week we'll have another edition of Inside Insurance.
Thank you.
Again for another episode of Inside Insurance, right here on the most influential name in radio, I-95.5 FM.